Hey, good morning, everybody, and welcome to Boca Raton here at Trevor Hall of Mining Stock Daily in this week's long-form episode. And Boca Raton at the Rules Symposium all week, and all the listeners throughout the week will know we've been putting out a ton of interviews throughout the last few days, and today is no exception. In fact, you got two segments. We're going to start out with our good friend Grant Williams from Things That Make You Go, talking about first principles of investing in crisis. And then we're going to go back to the mining sector with Matt Geiger from MJG Capital, talking a lot of the big themes that have hit the market this week. What a crazy week when it comes to metals and mining, specifically in the United States. So that's one to follow. Special thank you to Revival Gold, Vizsla Silver, Equinox Gold, and Integra Resources for continued support of the podcast, allowing us to do all these reports, all these interviews in beautiful places such as Boca Raton. Big thank you to our host, Rick Rule, as always, for an incredible event this week. It was, it kind of feels like we're in a bull market. So a lot of people here, a lot of new faces, so that was great to see. All right, everybody, let's jump into it. Again, two segments, Grant Williams, then Matt Geiger. Have yourself a wonderful weekend, and we'll talk to you on Monday.
One of the things I always love is finding people who I know very well, but these conversations don't happen as frequently as I would like. And so when I get a chance to sit down with Grant Williams in person, I make sure to do that. We were not able to do this back in South Carolina, Grant, during Jared Dillion's conference.
That's right. It was all a bit rushed.
That's fine, because now you've got a new presentation. You just launched.
I do, yeah.
Is it a launch? Can you call it a launch?
I think that's a bit grandiose, to be honest. If you'd have seen me sitting in bed this morning at 7:30 trying to finish the damn thing, there's nothing grandiose about it. No,
yeah.
So I don't think it's a launch.
They're always really, like, the presentation is spectacular.
They're fun. I really enjoy doing them. I don't do as many as I used to, but I do enjoy doing them. And this one was fun to put together. It's it's an interesting thing, because you want to entertain people, but you want to make them think.
Right.
And when you come to these conferences, there are so many other speakers, and you kind of know the kind of presentations a lot of them are going to give. So you've also got to think, well, I want to be different. I don't want to do the same thing again, because that'll just be boring for people. They don't want 15 macro presentations and 100 on different mining stocks and what have you. So it's like, how can I have a bit of fun with this and do something different and maybe give people something to think about? That's really all you try and do, and it's a lot of fun, I have to say.
Yeah, well, I mean, you're not a mining stock guy. Like, I know you're a gold guy. You have always talked about the importance of gold, and all of 2024, that presentation was really, that presentation to who are you? You talked a lot about the price action of gold and what it represents to everyday lives and the housing market. I remember that vividly because I'd seen it a couple of times. But you're not a mining stock. You're not a mining stock guy, and so I don't think anybody ever assumes you're going to come in to an audience to start talking about why you need to own mining stocks.
I don't think they are. I hope not, anyway, because they'd be disappointed. They'd be disappointed because there are things that you really need to know to talk about them, and the resource space is one of them. Right? You need. I have an understanding of it, but not a knowledge of it, right? And they're two very different things. And if you're going to talk about these things, you need the knowledge. And I mean, look around us. There's 200 people here that really do understand that industry. And I know enough to be dangerous. I know enough to have made some money over the years. I know enough to have lost some money over the years. But I don't talk to anybody about specific stocks, because I just don't see the value in me doing that. Everybody here is got something to push, and so for me, it's a question of, okay, you're going to be inundated with suggestions of something to buy.
Yeah. What
else can I give you to take away from here that in 6 weeks, when the stocks move 20% in a given direction, is still useful to you? And so that's really where I start from. Is what can I give you that has some longevity?
Yeah. So the title of your presentation this morning, and I'm sure a lot of people listening will potentially be seeing you, in more speaking engagements throughout the year. But you called it Principles and First Principles and the Lost Art of Investing Through a Crisis.
Yeah.
So I thought crisis was
crises.
Excuse me.
Yeah.
the crises was quite interesting because it made me think. It's like, okay, there's obviously a lot of volatility, everyday volatility right now and that's been going on for a long time, since 2020. Volatility is abundant, but I thought the use of crises was quite interesting. Like, it made me want to ask you, like, do you feel like, are we in a crisis right now?
Well, this is the interesting point about this, and it was one of the points that I tried to make in the presentation at one point, is that, I started off, I got everybody in the room to raise their hands if they thought the world had changed since 2020. And pretty much everybody in the room, I don't know whereabouts you were sitting in the room, but pretty much everybody raised their hand and said yes. Yeah. So you start with that. You start with, okay, you all believe the world has changed. So if the world has changed, it's either gotten better or it's gotten worse, probably, right? From an investment standpoint, because the conditions in the world lead to investment outcomes. And the point I made was that we've had 40 years of the most benign, I know at times it's been stressful, 08 and dot-com bubble and COVID, but when you step back far enough and look at what's happened over the last 40 years, and I asked another question later on in the presentation, I said, given everything I've just showed you about what's happened in the last 40 years, should it have been easy or hard to make money? And again, almost every hand went up in the room saying it should have been easy to make money, and it should have been, right?
Yeah.
That's the reality of it. Now, we make it hard for ourselves, but we've had the most benign conditions imaginable for 4 decades. Low rates, strong equity markets, strong bonds, expanding balance sheets, low inflation. Everything that could possibly go right has gone right. And yes, we've had a couple of hiccups, but they've been smoothed over and bailed out because we've had access to cheap funding and we've thrown money out and it's all been fine. So you get to that point, you explain how the world has been, and you're not really explaining it to people. You're just saying, well, hang on a second, have you actually spent your time thinking about this? Because we don't spend our days thinking about the last 40 years. We spend our days thinking about what we're doing in an hour's time. And if we're investing, we think about what's happening next week. We never sit back and look back and think, okay, what's happened and why? Why have I been successful? Is it because I'm a genius and my stock picks go right every time? If that's the case, fantastic. Keep doing what you're doing. But for a lot of people, you've done really well because you happen to have been alive and investing in the most perfect set of conditions you're ever going to have. Mm-hmm. So with that being said, if you accept that to be true, which people did, and you also accept it to be true that the world has changed, there's something that needs to be done here. Because if the world has changed, it means by definition those conditions are no longer going to be the conditions you're dealing with. Now, could they be better than that? They could. But I then went through to show exactly why they're not better, because of the build-up of debt and all the other things that are actually problems. So the assumption is that it's not going to be as easy to make money in the years going forward. And if that's the case, what do you do about it? If you recognize that it's going to be harder to make money, you need to sit down and think much more carefully about what you commit capital to, about how you handle decision making, about how you build your framework for making the initial decisions to buy things. There's a whole lot of stuff that needs to happen when the world changes that we don't really spend any time thinking about because we get caught up in the now and the here. And so really all I was trying to do was, if people walked out of that session thinking, I hadn't really thought about that, then I've done my job. Yeah. And if they take it from there and then start to think about it, I think they'll come to some interesting conclusions. And if they don't, hopefully people had a good time and, people laughed at the right places. And so, there's not much else you can do apart from that.
Well, I think it challenged my thinking. I was trying to think back what was going on in my head and also pay attention to your presentation at the same time. And in the last 40 years, I guess hindsight's always 20/20, but it was incredibly easy. You buy the S&P, you buy some call options, you use leverage. I mean,
all these you don't even need to get that cute. Just buy the S&P.
Which is why we continue to be the wealthiest country in the world, and why it's become so important politically to keep the ball rolling. But if you go back, I kept on thinking, it was like, but Grant, I wanted to raise my hand. Grant, 2022, the bull market, the bond bull market ends.
Yeah.
How we balance? How are you looking at that as we now move into this new political sphere where the politics want lower yields, the central banks, especially Jerome Powell, is very hesitant to make a move, and the market itself is, in the last couple weeks of trading after the one big beautiful bill is passed, is telling you to like hold your horses. This is starting to get out of control once again. There's a lot of dynamics to balance here.
There are. I mean, there always are. That's the beauty of this thing. But I made that point in the presentation and said that if you think the world has changed and you recognise that we could be heading to a pretty tricky patch post-COVID, but if you only look at the world through the lens of equities, as I said, it doesn't really feel like it's changed at all, right? Equities are back up, they're bulletproof, they're at all-time highs, bouncing around. There's no real signs. The phrase I used was the evidence was inconclusive, and it absolutely is. But if you look at the bond market, it's a much clearer picture that's being painted of strain and stress and finances that don't quite work anymore, and increased nervousness about the United States' ability to fund itself. All the fears are being represented in the bond market, and the action in the bond market is very different to that in the equity market. But, Americans in the aggregate have 49% of their wealth in the equity markets now, which is amazing when you look at other major markets, which are all down around 10, 11, 12, 13%. Yeah. I mean, the US is an outlier in every possible way, and that's been great. But again, it's been great, but everybody in that room thinks the world has changed. So if it's been great, but the world has changed, where do you take that next thought? What's your next thought if you agree to those two things? Surely it should be, I need to recheck my thinking, and do I believe that even though the world's changed, America is going to still be exceptional? The American equities are still going to outperform? And maybe you come back with the answer yes, in which case fine. All I'm saying is do the thinking. At least take the time to think, wow, if I really think the world's changed, is there anything I should be doing about that? That's the question you need to ask yourself. And whatever the answer is, go with it, but at least ask the question. You
cut your teeth in Japan, and you recollect about that cycle quite frequently.
Yeah.
I don't know if we've actually had this discussion here between you and I on this podcast, but I mean, I've listened to practically everything that you put out I consume, so I know the answer, but let's talk about it here today. How is this, looking at the United States economy and market today, what is reminiscent of what you witnessed and worked through with Japan in the 80s?
That's a really interesting question. My immediate reaction to that was nothing's the same, which is interesting. I'm trying to figure out why I immediately went there. And I think it's because, at the time, Japan was very much the up-and-coming market. Japan was the new star, right? And so the money that was going into Japan was going there. It was almost a frontier market. It was going there in search of opportunity, in search of this, in search of that. It doesn't feel like that's the case with America to me. I could be wrong, but the way it feels to me is that money's going into America because it's the best option. It's kind of, well, where else are we going to put it, right? It's not going there because they're thinking America is exceptional right now. It's the best place in the world to put money. They're going there because the American market is performing the best. And they're two very, very different things. And again, this is a theme that I talk about in a lot of my presentations. The idea that the process of investment used to be identifying good companies and good businesses and good management and investing in the business and being an owner of that business because you like the cash flows, you like the way the management run things, you see the opportunities for growth, all those kind of things. And now it's about the stock price, period. Yeah. People just want to know whether the stock price is going up. And so in Japan in the 80s, it was all about, man, just imagine the company Toyota could be one day, or the company Honda could be one day, or all these incredible companies, Shimano, the bike gear manufacturing was a stock I traded more times than I care to remember. When it was a nothing, it was incredible stock. So the money going into Japan was looking for great companies with great prospects that were undervalued. Now, there was a lot of money that came later, the parabolic blow off top was money chasing. But I don't see that in America. I don't see people saying, wow, America, there's all these great companies and they're doing incredible things. They go, well, it's the only game in town. Mag 7, let's herd it all into that. The S&P 493, absent averaging the big 7, is basically flat on the year. So it does feel very different to me, and I'm kind of thinking about why I felt the answer was nothing on the fly, and this is what I'm coming up with. So I'm just kind of thinking out loud. But it doesn't feel like Japan to me at all. America doesn't feel exciting to me.
Yeah.
It feels inevitable.
Did Japan in the 80s, and maybe I already know the answer to this question, but it doesn't, to me, I mean, granted I was 6, Grant, so.
Okay, thanks, pal.
It didn't feel like there was this, and I know there wasn't just this conglomeration of passive funds, ETFs.
No, there wasn't. Well, you had the Japan Postal Service, you had the pension funds in Japan, you did have that, but it was nothing like what we see today.
Yeah, and now there's a new ETF every day.
Yeah.
Quadruple leveraged from all I care. Yeah. But it's just insane. And I'm starting to see, Mike Green, your friend Mike Green has talked about maybe we're starting to see a plateau of funds coming into some of these.
Yeah,
passive
it's very interesting to hear Mike say that. And so if Mike's saying that, people should be listening.
That's definitely one to watch very closely. And that's not a question there, just kind of was recollecting and speaking out loud. You had mentioned this big change, starting in a lot of people assume that COVID-19 and the monetary reaction of 2020 kicked off this big change, but you actually said it was pretty quick this morning. I actually think it started in 2008.
Yeah, I do.
And I think I tend to agree with you, although there's that time period where we just started to see more growth, but that was on the back of, again, easy money, ZERP, and all those other things. So, maybe let's piggyback on that, the beginning of 2008, and how it almost seems like it's quickly forgotten.
It is. I think if you lived and traded through it, you'll never forget it. But a lot of people who did that, not really around anymore. There's a lot of people that aren't, and there's a lot of people who were so new in the business it didn't. I remember the 87 crash happened when I was very new in the business, and it was a big event, but I didn't understand it. I wasn't savvy enough to really understand what the hell was going on. It was just a couple of bad days, like what the hell just happened? So there were plenty of people that saw 2008, saw Lehman go under, and saw the TARP, and saw all these things happen. And without the context, it's very difficult to truly understand what happened in 08. But I think that was the crisis there. I think that was where the system broke. And I think that everything that's been done since to keep this thing together has been successful, in air quotes, if your measure of success is keeping equity markets high and for a period having bond markets through the roof and having financial assets maintain their outperformance. If that is how you define success, then mission accomplished. You were successful in averting the crisis. Of course, you look at what it took to achieve that success, and that's all there on the balance sheet and in the Federal Reserve balance sheet and in the federal debt held by the public in the US and all around the world. We can see what it took to win this success, and it's not a one and done thing. So that debt is still there. The added fragility that it's introduced into the system is still there, and the crisis is still rolling. I believe. I mean, I will discuss that with people all day long, and I have great sympathy with people saying you're talking out your hat. I get it. I don't say that I'm right. I say that's what I believe. And so I think when you've got this rolling crisis that keeps threatening to come back, whether it be in the bond market, whether it be in the Silicon Valley Bank thing, there are all these signs, and you can trace all of them back to 08 and what happened in the aftermath of 08 to how it was fixed and why that has made the system and the foundations of the financial structure weaker. So, I don't feel like we're out of the woods with 08 yet. I don't think many people will point to 08 if the world has another meltdown like that. But to me, the lines go straight back there, and the fact that everything was done and anything was done to stop whatever was going to happen in 08 had the world been left to its own devices from happening. And it wasn't going to be good.
I feel like everything that comes out of the White House, no matter what administration, is working on a way to prevent something like that happening, keep the money easy. keep the wealth abundant, or at least in the hands of the people that vote. The wealthy keep getting wealthy. I mean, I think you do see that in the One Big Beautiful Bill. Obviously benefits people with assets, benefits corporations, and arguably doesn't do great for people who are in the lower class. I mean, quite frankly. Now, whether that's right or wrong, I mean, that's a moral discussion we can have in another time. But I think as far as like watching where the purpose of the bill to keep assets up, to keep corporate profits high, give another leg into a next cycle, I think that's pretty obvious where this thing is. The tariff discussion, though, is where I get lost. And I just, I understand the argument that tariffs are inflationary. I also understand the argument that tariffs can be deflationary. And there's just been so much hullabaloo, back and forth for the last 3 months.
Yeah.
That we don't have a clear direction on where this thing is going and exactly how it's going to benefit. So, I mean, it's almost like a crisis that we're implementing on ourselves, just because we say we're going to do one thing and then we don't. It's the taco trade. So
yeah, it's interesting. We had a panel last night, which I was on, and Jim Rickards was on it. And Jim's a very smart guy, and Jim's got a lot more access than I'll ever have, and I'm glad he's got it, not me, frankly. But he said that he'd worked with the Trump transition team, and he was adamant that the Trump administration have an incredibly complex, almost 3D chess plan, and this is all part of the plan. All the flip-flopping and backwards and forwards with tariffs and extensions and non-extensions, and he was adamant that this was all part of the plan. It's a brilliant plan, his words, not mine. And just you wait and see. I will wait. I don't know if I'll see, but I will wait, and I'm not going to, like I said, I don't have the insight and the connections that he has, but from where I sit, I don't see that at all. I see chaos, right? And I see other people who are affected by this. You can see the way they view America changing. And there have been times in the past where that wasn't a problem for America. America was so big and so powerful that however you view us, doesn't matter. We're who we are, and you're going to have to deal with that. And one of these big things about change and this idea that the world has changed, America plays a big part in that. America's changed. The America of 2025 is not Ronald Reagan's America. It's not Jimmy Carter's America. It's not George Bush's America. It's not even Barack Obama's America.
I was going to say it's hardly Obama's
right?
America.
It really isn't. And that's not. I'm not saying that Trump has changed this. I'm saying post 2008, as the measures to keep things going have gotten more desperate, America's fiscal situation has been steadily undermined by Obama, by Trump, by Biden, by Trump again. Not necessarily because they think, hey, let's undermine the fiscal strength of America, but let's either keep the party going or stop the wheels falling off. And this is how we do it. So, I know what you mean about the tariffs. It's difficult to keep up. And, we saw something today about they're not going to get extended past August the 1st is the latest thing.
Right.
I mean, who knows? We'll know on July 31st.
August the 1st.
July 31st, probably. I don't know, but I think there's so much noise there, and I think if you are trying to quote unquote invest around the tariffs, you're making the world way harder for yourself than you need to.
So actually, that's a good point, because in your presentation, you had brought up a lot of your in heartfelt conversations with your friend Tony Deaton, and he plays that conversation the way Tony approaches investing. It's predominant in your presentation. I don't want to give it away. I want people to search you out and go listen to you speak it. But it's very sound way, and the way you have communicated that approach and kind of those first principles in investing. I didn't even think about tariffs.
Right.
It was like one of those things like you stick to these first principles, you think deeply about them, you don't act quickly, you don't go in and out, you invest, you don't trade, and knowing that your positions can stand the test of volatility that a politician or an economic decision can kind of fend off,
Yeah.
you're going to sleep a lot better, and these conversations would be less frequent.
Yeah, you're right, and that comes down to finding durable, resilient businesses, right?
Yeah.
Businesses that the tariffs don't really impact. Even if they impact them, they are strong enough to weather that. They have margins, they have ways of either passing the tariffs on, or they have ways of offsetting them. There are businesses that will look at the tariffs coming in. It's not just oh no, here's what's going to happen. Okay, it's like, how do we react to this? And the whole theme of the presentation was adapting to change. And good businesses do that. The tariffs get announced and they immediately adapt. They change, they figure out how to deal with it. They're robust enough that it's not going to actually hurt them. It might impair them for a quarter here or a quarter there, but they have ways of actually mitigating that stuff because they're sound businesses. What's happened over the last number of years, it's not been about the business, it's been about the stock price. Mm-hmm. And if you've, again, we come back to this idea of change, if you've been investing because you thought the stock price was going to do X or Y, I don't know that that's going to work anymore. I think now it's time to go and say, okay, I need to invest in a business that's going to perform under these conditions, and a business that has a strong customer base and has loyalty and has a niche and has a moat, and there's all the things that used to be the reasons you invested in companies, not stocks, companies. And so, one of the big changes for me is going back to the idea of investing in a company, in a business, and not investing in a stock. Because when you call it a stock, it could be anything, right? It's just a ticker. And I know there are tons of people out there who have bought stocks, who've bought ETFs, who literally don't even know what they do, but someone says to them, hey, you should look at this XYZ ETF, or I'm buying such and such a ticker. Oh yeah, I'll have some of that too. When it works, it's great, and it has worked. When it doesn't, and you have no idea what it is you own, and we were talking before we started recording, and you were telling me, I hadn't seen it, but you were telling me that the copper price had jumped 17%. Yeah. I guarantee there are people out there who own a short copper ETF who are going, hey, why is my position down?
Yeah, why am I getting smoked here?
And they call their buddy who said that you should buy this CUF or whatever it is, and why is this down? Well, dude, copper price. Yeah, and we all have to take responsibility for our investments, and that responsibility has always been paramount. But in the last little while, you could get away with not taking it. You could get away with doing things because someone says it's a good idea, or you had a tip, or you've got a feeling that X is going to go up, Y is going to go up, and it didn't really matter to you what the company did. You just looked at the chart, looked at the ticker, and said, hey, you know what? XYZ's going up, I'm going to buy some. Yeah. What does it do? Does it matter? It's going up. So bottom line, it's a different world. And I think in a different world, you have to think differently and expect different outcomes. And that's not an easy thing to spend time considering, but it's an important one.
Yeah. I want to leave with one last chat. We got to talk about gold, because you said something today that was like, God damn it, Grant, you always have the right words. You said gold is something you own, not something you buy.
Yeah.
And here we are. If you were to take a step back a couple of years ago and knew that gold was going to go to $3,300 an ounce, and that most Western investors would still be under allocated to precious metals, would you be at all surprised?
Well, here's the interesting thing. I won't say I knew, because I didn't know, but I felt very confident gold was going to $3,300 and higher. I just didn't know when,
right? And
I didn't care because it wasn't about the price for me. And so that's another part of this. When I talk about don't buy gold, own it. As soon as you say I'm going to buy gold, there's an implication that it's for sale, right? If you say, I own gold, I own my house. I don't check the price every day thinking I'm going to sell it, right? But a lot of people will, I'm going to buy a holiday home. Different, the price has gone up. I've got a friend in the UK who bought a holiday home in Spain. He's just trying to flip it. Mm-hmm. There's a difference. The mindset of being an owner is very different to the mindset of being a renter. And what's happened is when you focus on the price, the tendency is to rent things. And gold's the classic. I guarantee you, every single time I give a presentation and I talk to people afterwards, I guarantee you that one of the first 3 questions I get asked is, do you think the gold price is going to go to X? Or where do you think the gold price is going to be at the end of the year? And I always feel really bad. I feel like I'm disappointed when I say I don't care. Because I genuinely don't. It's not about where the gold price is going to be. It's what does that gold, what can I exchange that gold for? Yeah. And I did a whole presentation on this last year, a whole section of my presentation last year showing that the median house price in the US, which, as I showed today in the chart, is unaffordable to an extent it hasn't been in the last half a century. The median house price in ounces of gold has fallen 71% since 2003. So the price of gold is irrelevant. If I had 100 ounces of gold in my safety deposit box that would buy me the median house 25 years ago, if I opened my safety deposit box, I'd only have to take out 29 of them and I could buy that same house. That's what it does. It's not about the price. So everyone has different ways of looking at it, and I understand why people get fixated on the gold price, because what else can you get fixated on? It doesn't have cash flows, it doesn't do anything, it's a price. Right. But that way of thinking, if you think about gold like every other, and in fact any other financial asset, I think you're missing the point, because it's unlike any other financial asset. It's unique in many, many ways, and so given that, you need to find a unique way to think about it, and that starts with not focusing on the price, to me.
Yeah. Before I let you go, I do want you to know that the podcast series you're doing with Dimitri is incredible.
Yeah, I'm enjoying that. Really, Dimitri's terrific.
You guys are like 2 peas in the pod. You were meant to do this. In fact, I don't know why it didn't happen any sooner.
Yeah, we've been looking for something to do together for a while now, and we finally come up with this idea, and we're overdue another one actually. But they're great conversations, and Dimitri's he's terrific at what he does. He's just the best man.
Yeah, he is the best.
Yeah, and I love doing those with him, and I'm hoping we can record another one pretty soon.
Yeah. All right. Where are you off to next?
Back to the UK to see my grandkids and my father. So that's my next stop, and I'm literally putting the microphone down and heading to the airport. So.
Well, thanks so much for your time.
All right, brother. Always good to see you. Thanks, man.
All right, everybody, we continue right along here, and we're going to make this our second segment here on this week's long-form episode, coming from the Boca Raton and the Rural Investment Symposium. It's always a pleasure when my team, Chelsea, comes in after a big win, and I get to sit across the table from my friend Matt Geiger, Tottenham supporter, and just really just relish in how amazing my team was in the Premier League this year and how god-awful yours was.
Yeah, I don't quite know how to respond to that. I do wish you luck this coming Friday.
But you did win a trophy.
We won a trophy, first time in 17 years.
And then you fired your manager.
I was bummed about that. I was Anjan. It was very much a head versus a heart decision, but I mean the guy delivered us silverware for the first time in over 17 years.
Was it 17 years?
Yeah, it was bad, man.
My God.
Yeah, it was like,
you finally have to dust off the trophy case and put something in there?
I started supporting Spurs seriously in 2007, and we'd won a trophy within 9 months of me first supporting. So I was like, oh, this is going to be easy.
It's like
peaches and creams from here.
It's like investing in the junior market in 2008 and thinking you're genius.
I like that. That's very much true. It went straight to my head, right. And I learned a very painful lesson in the ensuing 17 years.
That's right. Here we are. Okay, so enough. I'm sorry to gloat, but I had to. Let's talk about where we're at in this market. There's some really interesting news items happening. It seems like every week this sector is like inundated with something new. A lot happening in the royalty space as of lately. Obviously, a big transaction earlier in the week with Sandstorm and Horizon Copper getting taken out. Get bought up. There was news a couple weeks ago with Tether coming in as a major shareholder of Elemental Altus royalty. There's some new companies, some new royalty companies coming online. I mean, this thing is just like a huge freight train moving. I'm not quite sure which direction it's heading, other than the inevitable some sort of consolidation.
That's right. I mean, it's been really exciting, to be honest, and folks like myself have been calling for consolidation within the royalty space for 2 to 3 years at this point, and it's been such a sleepy sector. But I mean, you hit on a lot of the key points here. Just in the past 90 days, we had the Origin deal with Triple Flag, $420 million takeover there, largely for the Silicon 1% NSR, covering that project with the rest of Origin's business to be spun out post-close. We had the Elemental Tether news, which I did a 6-page write-up in our most recent investor letter, kind of going through the nitty-gritty there. Not technically M&A, but I think it could be a precursor to M&A, certainly.
Well, maybe let's talk about this, because I think this is fascinating. I mean, we did have Fred Bell on, their supporters of the podcast, and so him and I had to chat about this whole thing. Obviously there's only things that he can share from that, but you and I can sit here and speculate until the cows come home, right? So let's speculate. Like, what is Tether coming in? You're looking at the 5th largest holder of U.S. Treasuries. It comes out, they finally put a number on their gold that they own $8 billion of physical gold.
It's wild.
Isn't that wild?
Wild. And buying more weekly.
And then they also, obviously, they hold physical land too. I mean, that's maybe a whole nother side story. But this is remarkable. So you have this huge burst of liquidity available that nobody else in this room, well, maybe it's select few, but 90% of the people in this room in this exhibit hall have.
Right. I mean, I have a lot of thoughts on this. I guess one question that arose immediately after the deal was announced is, what is Tether's intentions with the Elemental shares? And will the newly acquired Elemental shares, Tether now owns 52% of Elemental after taking La Mancha's stake, after signing an option agreement to purchase Alpha Stream stake, which should occur in October, November of this year. And then they've also taken a few blocks from some smaller institutional shareholders. So they're at 52%. My read of the situation is that these shares will not be used to back any of their stablecoin offerings, and instead should be thought of as an investment for Tether. Tether's generating $3 to $4 billion per quarter on its various stablecoin products. They're just raking in the cash. And the vehicle that Tether used, called Tether Investments, should be thought of as an investment vehicle for Tether to, in essence, deploy the excess cash that they're churning out. So that was the same vehicle that was used to buy a 70% controlling stake in Adecoagra SA, which is the Latin American agricultural giant. That occurred in spring of this year. And so it seems clear to me that Tether's pursuing a diversification strategy because they have so much exposure to U.S. Treasuries and the U.S. dollar by nature of their flagship USDT product. I think they want to make sure that the company's well insulated with some other non-correlated assets, Bitcoin obviously being one of them, and then precious metals and the hard assets more generally being another avenue for them. So that was one question. Where's this money, where are these shares going to go? Second big one is, what are their intentions as the controlling shareholder of Elemental? Right. And in the write-up, I highlighted 5 different potential possibilities. One of which is that they're aiming to take over Elemental entirely. That this is the first step in that process. I don't think that's ultimately what's going to happen, but it's worth noting a possibility. Second is that maybe we see them acquire some controlling stakes in some other junior royalty companies. There's about 5 or 6 similarly sized precious metal focused junior royalty companies in kind of the 200 to 500 Canadian snack bracket. I don't think that's what they're going to pursue, but it is a possibility worth noting. Third is they could come to either an explicit or an implicit co-investment agreement with Elemental, where they basically say, you guys know the space inside and out. We want exposure directly to royalties and streams. Why don't you go source some bigger deals for us? We'll take half the deals, and you can take the other half of the royalty and stream, put it in your vehicle. A fourth option is that they plan to use Elemental as a consolidation vehicle within the junior royalty space, which I think is very much overdue for that to occur. And then the fifth is that they're just a supportive, long-term, and admittedly very large shareholder and help Elemental grow their business royalty by royalty, stream by stream, as they've done to date. Based on hours of conversations I've had with shareholders and folks close to the deal, including CEO Fred Bell, my sense is that option 5 is ultimately what's occurring here. These guys are going to be supportive long-term shareholders to help Elemental grow the business on a deal-by-deal basis. But I should also note that the Fifth Avenue is not mutually exclusive. So it could very well be a combination of, opportunistically looking at M&A if the opportunity does present itself. And then also if there's a really attractive royalty or stream that Elemental has its eyes on, but it would take a disproportionate weighting within the Elemental portfolio, there could be an opportunity for them to co-invest, with Tether on kind of a one-off basis.
Yeah.
And then maybe that royalty or stream could be vended into Elemental at a later date. Once their portfolio can support it, as they don't want to get too top heavy. So still some uncertainty until ultimately how it's going to play out, but that's my best read of the situation.
Yeah. Are you coming at this? Are you a shareholder of Elemental?
Yeah, we've been shareholders. Well, technically, we were shareholders of Altus Strategies going all the way back to 2018. So we've been long-term shareholders. Elemental Altus was, of course, formed. I think this was August of 2022 when Altus Strategies and Elemental Royalties merged into Elemental Altus.
So that's the vehicle in which how you acquire the shares of Elemental.
Yeah, exactly. Yeah, through that merger. And I mean, I've been writing about Altus and then Elemental Altus once the merger occurred. And every MJG investor letter going, I think, all the way back to 2021, if I'm not mistaken. So it's a company that I've followed very closely and talked about publicly on quite a few occasions. I mean, it's super exciting. Obviously, the market reaction has been very positive in the aftermath of the deal. I think as of yesterday, they were up 35%. Off of the back of the Tether investment. And if you look at their year-to-date performance, Elemental's up close to 75%. So it's in the top 3 or 4, highest performing or best performing royalty names year-to-date.
So you and I are both coming at this as shareholders of the company. I was late to the party. I actually bought following this Tether news.
We did as well, just a little bit. Yeah, it wasn't a huge.
It was one of those news items. Like if you were paying attention, and you're sitting back, and it's like, listen, all these companies are looking for the best access to liquidity and deep pockets. Well, one of the deepest pockets just fell in the lap of Elemental here following this deal. So you have that. That's a checkbox, right? But it's also this ongoing debate between the physical market and the digital world has been ongoing, since you and I have known each other here, Matt, going on 8 years now, I would say. You and I have been friends and talking shop here. And we've had when is the digital wallet going to meet the physical demand for the metal? And people have tried, companies have tried, and it's just never really made much sense to me. It's never really clicked. I've always had more questions than maybe I've given myself answers to, and that's been a hard thing for me to swallow as an investment thesis. To go in and see the big picture with what those moves were. But then this happened. It's like, this makes sense.
It's exciting. I mean, I hesitate to draw any very broad conclusions from a single deal. This could totally be a nothing burger for anybody other than Elemental shareholders, or perhaps it's relevant for Elemental shareholders and the shareholders of some similarly sized junior royalty peers, but doesn't apply to the rest of the mining market. But I will say we should, leave ourselves open to the possibility that this is a harbinger of non-traditional mining capital, whether crypto-focused or otherwise, coming into the space en masse.
Isn't that what we're looking for?
That is what we're looking for.
And aren't we tired of trading amongst ourselves?
Yep.
Like, I send you all my dogs and you buy it on the cheap.
That's right.
Aren't we done with that?
So I'm excited about that possibility. And again, it's just a possibility, but this could be a signpost, kind of where we are in the cycle in that respect. It could also be a reason for caution from a broader sense. I mean, maybe this is a sign that the bull market, at least in the case of gold, is getting longer in the tooth, or it's not in the early innings, is now in the middle innings, to see a non-traditional mining group come in at this size. And it could also be a sign that the royalty and streaming business model, which is relatively new innovation in the long scheme of, in the long arc of the mining industry's history, that is becoming more mainstream, because it's really fascinating of all the different companies, all the different business models that Tether chose to deploy their first capital into the mining space. They went royalty and streaming. So we'll see.
I know I had a conversation with a good friend. I'm not going to disclose who it is, but people know him. He writes a really great newsletter. He's more generalist macro guy. And when the news hit, I called him up and I said, listen, I think this is so new, and it's so new it has to be important. I just want you to be aware of it. And so I told him what happened, what Tether did. And as this generalist, he's not necessarily a mining guy. He pays attention to the market, but he doesn't go in hardcore like a lot of us here. He said, that's interesting. That piques my interest. Tell me more. And so that alone, having this moment where it causes people to kind of perk up a little bit and start paying attention, I think is incredibly significant, and maybe it's just anecdotal, I don't know, but it feels like, okay, we are starting to move in the right direction here.
Look,
in a cycle.
I've had a similar response with the investor letter that was just sent out. I mean, I have about a 2,000 person distribution list, and maybe 60% of those folks on the list are mining specialists or mining focused, and the other 40% generalists. And the amount of feedback that I've gotten on that piece in particular has been pretty overwhelming. So I think it does resonate with a broader audience, and certainly piquing folks' interest. And we'll see where it proceeds from here. The jury is still very much out.
Okay, let's talk about something that is important and very newsworthy. Obviously, we got to talk about Donald Trump. His comments on copper. Copper, 50% tariff on copper. I was actually, copper spikes 17%, settles. I think here we are recording Wednesday morning. Matt, I think it's still up, 10% from the lows. I have to check the chart. Just incredibly man-created volatility in this space. The trader in me yesterday, Matt, I was like, the trader in me wanted to fade that move. And maybe if you caught the top, that would have been a good move, but it would have been a quick trade, because I don't know where it goes from here, because we don't have any clarity what these policies are going to be come July 31st.
Right. I mean,
how do you manage this with your portfolio?
Well, this is Donald Trump at the end of the day. So, and anything that he says needs to be taken with two massive servings of salt. And it should be noted, this is not stated policy of the U.S. government, at least as of yet. This is a spontaneous answer to a question that was shouted to him at a press conference. With that said, it is certainly significant. I mean, the move we saw in copper yesterday, it's a 20% move at its peak. I think it ended up closer to 10% on the day, but that is the largest single-day move in the copper price, going back all the way to at least 1968, where these records were first kept.
The shorts got smoked.
Yeah, that they did. But look, I mean, honestly, I think this could go ahead. Like, Trump did not hesitate to slap 50% tariffs on both steel and aluminum. And I don't know if he's thinking with the level of nuance to distinguish copper any differently from those two incredibly important materials as well. So I think we could very well see a scenario a couple months from now where there is 50% tariffs put on copper, and then maybe that's moved down to 25% as he comes to various trade deals with potential trading partners. Like, you'll note the UK, their tariffs on steel and aluminum have been lowered to 25%. So he could just be using this as another cudgel.
But the trade agreement with Chile becomes very significant very quickly.
Certainly. I will note the market is kind of in your camp, though. They're skeptical. Like, if you look at the spread between the COMEX and the LME price, it's still just less than
24%.
Yeah, like 23-24%. So the general, or I guess the market is in disbelief that this will actually occur, but I certainly wouldn't rule it out. And it's fascinating. I mean, there's definitely some winners that crop up immediately to mind. Kind of first and foremost would be these later stage U.S.-based development plays.
Yeah.
And funny enough, I had a meeting scheduled with Arizona Sonoran yesterday, and we sat down probably an hour after that news hit the wire. So as you can imagine, both George and Allison there were very busy, fielding a lot of calls from shareholders. So that's one group that's a clear beneficiary. Their neighbors, Idaho Electric, are also expecting to produce a copper cathode versus a concentrate. TSECO and their Florence ISR copper project, that's ramping up. In theory, should be in nameplate production by the end of this year. That's another potential beneficiary. Gunnison Copper, utilizing Rio Tinto's Newton technology, is trying to get a small operation up and running at the Johnson camp. So I think the late stage U.S. developers that are aiming to produce copper cathode and not copper concentrate are a clear beneficiary of the news. And the other big group that's a beneficiary would be those that operate smelters within the United States.
Well, there's not many of those.
There's only two. Yeah, there's Freeport and their Miami smelter in Arizona, which is a smallish smelter, but it's been in operation for many years. And then Rio Tinto, of course, with their Kennecott smelter in Utah. There's actually a third smelter that's been mothballed, I believe, for a couple decades, definitely for quite some time. That's owned by Grupo Mexico, and it's the Hayden smelter, also known by some folks as the Asarco
Arizona.
smelter.
Arizona.
And so I think that's certainly going to be fast-tracked back into production pretty quickly here. But I mean, for general numbers, as it stands, the U.S. already produces domestically 60% of its refined copper. So we're only dealing with 40% in terms of imports. I think if Hayden is turned back online, that will allow 70% of U.S. copper demand to be satisfied domestically. And then there's a gap of 30% if the U.S. wants to get up to 100% self-reliance. So that could entail three Hayden-sized smelters being built.
Yeah.
That could entail one Kennecott-sized smelter and one Hayden-sized smelter being built. And mind you, if any smelters are built at all, these are 5 to 10 year time frames, including the permitting. $1 billion plus, probably $2 billion or more if you're to do something like Kennecott of Kennecott size. But the other alternative is for these later stage developers intent on producing copper cathode to come in and fill the gap. So we don't quite know how it's going to play out. It could be that no smelters are ultimately built, and the copper cathode players do their best to fill the gap. And maybe by the end of Trump's term, we can get to where 70 or 75% of U.S. copper is produced domestically, relative to 60%. But I'd just say quickly, the losers of this, I would argue, are the American people, at least those that are living on the margins. Like, I completely understand the urgency around rare earths in particular. We have China just controlling and having a stranglehold on 90% plus of the processing of rare earths, and 99 to 100% if you look at the heavies. But we already produce 60% of our domestic copper needs here at home. So I don't view this as a pressing problem. All else equal, this will be inflationary. So in my view, just as a U.S. citizen, I view it as a misguided policy. But as an investor, I'm just taking it as it comes.
All right, let's talk the investment thesis. Last question here regarding U.S. copper. Obviously, Trump winning the presidency back in November, it was an obvious trade to go long U.S. copper projects, the trilogies, the Arizona Sonorans, Rio Tintos with Resolution. That happened. Started to wait this out. We saw a lot of price movement. Yesterday, there's another breath behind the words of the tariffs. I guess, how sustainable is this U.S. cathode development thesis in the future? Like, do we still have more legs to go? Is it getting to a point where you need to be a little bit more careful? Do you take profit where we're at now after that? Yesterday's big day. I mean, it feels like the easy money's been made.
I think that's a fair thought. If I were in any of these investments, I would want to make sure that my thesis didn't hinge on this 50% tariff being in play for the next 3 or 4 years. So if you're looking at a company like Arizona Sonoran, for instance, or one of the names mentioned, make sure it works at 450 or 425 copper, which is closer to where the LME price is trading. And if you can still view it as a exciting investment opportunity, even assuming this premium that we're seeing between the COMEX and LME erases entirely, then I think it's okay to hold your nerve and keep going with these investments. I will say the MJG portfolio, I mean, we're 35% weighted towards copper. Yeah. So it's our highest single weighting by metal. But I'll also say that our US-based copper exposure are earlier stage names. Mm-hmm. So we've not caught the move flush with the Arizona Sonorans or the Idaho Electrics of the world. I'm not chasing those names. I'm kind of sticking with our bets. We're already heavily exposed to copper, but I think it's good for the copper industry more generally. Like, it is definitely mixing up the waters.
I mean, I just reminisce a little bit of 2 weeks ago in the oil market. The geopolitical premium sends barrels of oil up, 12% or whatever it was, and it hits $77 a barrel. U.S. drops a bunch of bombs in Iran, and by Monday, Tuesday, it's like back to where it was at 65. I mean, and I just kind of wonder, okay, is it possible we see the same move in the copper market just based on this? If you see like a big spike and then a
quick fade back to where we were, which is still a healthy market. You're still talking $5 a pound, right? That's still a good market. But, you don't want to see a big spike and then 3 days later it's back to where you were because somebody walked back and the taco trade was
right. I mean, look, we all have different investment philosophies and different time frames. I try to take 2 to 3 year views with each of our investments, and so that entails tuning out a lot of this noise. Like, I just try to go back to basics, focus on high quality people that have good skin in the game and are focused solely on the opportunity at hand and have the expertise to succeed. Then look at the asset, and like we were talking about with these US-based copper projects, make sure they're not dependent on $5.50 copper to work. If they work at $4, $4.25 copper, then the rest of this is gravy. You look at the company structure, look at upcoming catalysts, look to price to value. What do you deem fair and expected value, and is there a substantial enough delta between the current price and where you think it should be that it's worth taking the bet? So I would urge folks to take a step back and just continue to focus on fundamentals, but I understand there's some folks with much shorter time frames and more trader mentalities, and that's just the way it will always be.
All right, my friend, it's really good to see you. How's things in California?
It's going all right.
Doing all right?
Yeah, it's been a busy stretch getting out the letter, but excited to be here in Boca Raton with you. And we have 6 of our holdings in attendance at this conference, which is a pretty good haul for a single conference. That's a good third of our portfolio. So it's just great to catch up with a lot of high quality people in the industry.
Yeah.
I think Rick puts on a really good event.
Yeah, well, I look forward to maybe one day hitting the road with you again and doing some site visits. It's always a good time having Matt Geiger on the ground with you, who asks way better questions to management than I ever could. So thanks so much.
That was fun.
Good
Thanks,
to see
Trevor.
you.
Good seeing you.